Guys, welcome back to the channel, welcome back to a new video. I hope you all had a good Christmas and good new year. We're back, 2023, back on track. I took some time off, went to a beautiful tropical island during the holidays, and in the last few days I wrote business plans for my company and where I want to go to and the plans for next year and all kinds of goals personally. And now I thought it was time to pick up where we left off and to create more content for upcoming year. I have some great ideas and plans, so definitely stick around, subscribe if you don't want to miss it. I think it's going to be a great, beautiful year. Have a good feeling about it. It was strange because I actually already had a good feeling about 2023 since last month. I was thinking about this year, and a lot of people are pretty bearish and negative. But I do actually think it can be a surprisingly good year because, let's be honest, 2022 was pretty bad in a lot of ways. We are going to dive in today's video. We are not just only going to look at Bitcoin. We are going to get a broader view, a big macro helicopter view over all kinds of markets and assets and what can we expect for upcoming year. A little bit of a light version. And then in other videos we are going to do deep dives into other stocks, other cryptos, altcoins, asset classes. So we are really going to widen up everything that we are going to talk about, and not just every day a Bitcoin video, because sometimes nothing happens in the charts and then it's just a little bit boring. Again, if you like the content, you would really do me a favor to like and subscribe. Click on the bell, click on all so you don't miss future videos. Also feel free to leave me a comment or share the videos with your friends if you think that's useful. Now let's start diving in. I first want to dive into this website, bitcoinmonthlyreturn.com. It shows you a little bit of the monthly returns that we had in the past for Bitcoin. And we're talking a lot of times about the cycles that we have. 3 years is up, 1 year is down, and so far history is repeating itself. But also, with that being said, very most likely the bottom is in, or very close to the bottom is in, and therefore next year, so this year 2023, should be a green year for Bitcoin. And that's also actually what I'm expecting, because we already went down so much, 83% in 2022. I hope that you can see it on your phone, on your screen. And the previous 3 years were of course green. Here you see at the end the return minus 83%. Now that doesn't mean that we can still drop down or retest the 15k, but in general we would probably go up. My very macro target for this year for Bitcoin is 30,000, 29k. That would mean 100% profit from where we are. Let's say from the bottom was at 15,500 ish to approximately 30,000 would be a double of your money. Maybe we will end the year lower, so I could see us grinding up in the second half of the year, second quarter of the year, towards that 30k and then to drop down a little bit. But in general, I think it will be a green year, and I will be slowly changing my bias to becoming a little bit more bullish and to prefer a little bit more longs than short, and that will of course be intensified in the next couple months, but also the years after, because you're then just getting a greater and greater return until the top of the bull market. Well, if we're looking at Bitcoin, then this is where we are right now. This is not completely updated, but I think from the top to the bottom was approximately 78%-ish off, and so that looks ugly. And where we are right now, right here on the right side of my screen, it looks so tiny, so minuscule compared to where we came from, the almost 69k. I do think that we are transitioning into something we call the accumulation phase, so where Bitcoin is barely moving. People are leaving the space, they think it's dead, they think it's over, but that is usually the bottom signal. That is the time to accumulate, so that's also what we call the accumulation phase. That accumulation phase doesn't take 1 or 2 days, it is usually a couple of weeks or a couple of months. I am aiming for end of the quarter, the first quarter 2023, so somewhere around March, maybe April. And then slowly maybe going higher. The same kind of price movement we have also seen in 2019 after the crash of 2018. just a sideways grind. Looks like nothing is happening, and then suddenly we're just grinding a little bit higher until you're really getting towards that phase where we're really just grinding up, as you can see right here, but it will take quite some time. If I'm zooming in just on the daily, I will do a thorough BTC analysis later today probably, but if I'm just looking at how much we moved from 21st of December until now, we're talking about approximately 2%-ish, so there's not a lot of movement. In the accumulation phase in the previous cycle, there were days where we just moved 0.1, 0.2%, and if I'm just moving my mouse, also see it, 0.2 on this day, 0.04 on this one, 0.02 on this one, 0.5, this was a little bit more, 1%, 0.5, 0.15, 0.45. So you see kind of where I'm trying to go to is that this is probably the accumulation phase where we're now transitioning in, and yes, we will probably go from 16k to 70k, 15.5, again back to 17. So there are maybe some trades to be made, but it is getting a little bit harder to do because of this sideways action where we are in for probably the next couple of weeks and months. So if you have money on the sidelines, and this is not financial advice, but if you have money on the sidelines and you wanted to buy it, then I think the accumulation phase is the best moment to do so. And why do I know this accumulation phase? Well, stocks are being traded by humans, and human beings have behavior, pattern behavior, so they always act in the same kind of way, and therefore stocks usually also have certain cycles, or crypto or other assets usually have certain cycles, and I will show you in a little bit where you also see those cycles coming back. So again, end of the year, I think we're higher. My macro target is approximately 29-30k. Not saying we're going to close the end of the year there. We also might just tap it early in the year and then drop lower, but I think that would already be a significant result, because then you're doubling down on your money. So if that could happen, then I'm a happy guy. Quickly then to the S&P 500, this is where we're looking at right now. We ended the year at approximately minus 20%. That is pretty bad. Of course, a full-on bear market, crisis, inflation, you know the drill. But if you also add the inflation on the stocks, approximately 10%, then you lost 30% on your stocks. And with that being measured, that is one of the most severe dumps, crashes, pain, downfall, however you want to call it, that we had in the last 70, 80 years, I think. Do I think the bottom is in? No, not yet. I have drawn here the fib retracement. I think we are going lower, and we are at least going to the golden pocket, but I'm hoping that we are at least going to test the 3500 because, as I always say, I do not really believe that it's just a tap and then just higher and thank you, that was it. I think there is more pain to come, but also for this year, I do think that we will not see another drop of, let's say, 20%. I do think that most of the pain is over. Why am I saying that? Well, it has never happened before. I think that we had 2 years in a row where we had a drop of 20%. Yes, we could drop 20% during the year, but eventually recovering it. So I am aiming for flat at the end of the year. Maybe a slight minus, maybe a slight plus, but not a plus of an average of 10%. What the S&P has as a macro track record is an average return of approximately 10%. I do not think we're going to hit that this year. There's just so much stuff still going on, but with the price movements, maybe we're in a plus for a little bit, 1-3% for the year, then we're going down 1-3% for the year, and eventually we're probably going to close down there somewhere. Minus of 10-20%, I also think it's highly unlikely to end the year on that number. There's one other thing what I'm looking out for. This, as you can see, was the Corona dump, and we also recovered quite fast. There is an interesting price point in the chart where we could go to, and that is maybe the golden pocket measured from the Corona dump all the way to the top, and then down here 3100 to 3200. This will be another macro target for me if we are going to break the 3500. I have 3280, which is very close by to the 3200, 3100 for the S&P 500. So if we consolidate somewhere here and then form kind of a bottom, that for me is the bottom signal, and then I think we can go higher. I am in, it's my opinion that I think that the first 6 months are going to be rocky, probably some more downward actions, and then later in the year we might see some price movements to the upside, also because the Fed, interest rate hike, inflation. But if that all is wearing off a little bit, inflation might then be really coming down, and the Fed is probably going to stop rising the interest rates at the end of the year, then I think there's room for stocks to rally to the upside. So first 6 months, probably a bit rocky, probably a bit more downside. Last 6 months, probably a bit better, probably a bit more upside. So that is in a macro where I'm looking at for the S&P 500. What I also just want to say as a takeaway, this might feel terrible. Yes, it was a year. Yes, it was minus 20%. But I feel like COVID and the pandemic was, quote unquote, kind of yesterday. I mean, there has been now more than 2 years ago when we started. But if you think about it, if you bought here at the dump of Corona, you are still up tremendously. Let's say you did not catch the exact bottom, but you have an average buying price of 2,750. You are still up 37% on your investment, although we just had this dump. So see stuff a little bit in perspective. And if I'm zooming out even more, and I'm looking here at the S&P 500 on the weekly, and we're looking at 2008. And if you bought during the credit crisis, or maybe even the years after, let's be conservative, not even take the bottom. You bought here around 2012 when everyone had kind of had a job again, and we slowly started to make money again, and the worst was really over. Then you would still be up 200%. You would have survived the Corona dump, you would have survived this. So it's just all a matter of perspective. Again, yes, it looks terrible. Yes, it feels horrible, and you think the world might be over. But if you just hold on to your positions, or you're buying on the dips, then you see with a horizon of multiple years, you will probably making money on holding on to your stocks or your ETFs. Then the Nasdaq, actually same kind of story. Nasdaq went out for approximately minus 30% of the year, so a bit worse than the S&P 500. I have been buying ETFs somewhere from here already, and I also bought something at the beginning of the year. Again, there's still room to go further to the downside, absolutely, but I think 30% minus on the year, that for me is just a screaming buy for a index ETF. We kind of touching the golden pocket here, also measured from the Corona dump, but not really hitting it into the golden pocket and have some consolidation. And also if we measure it from let's say the dot-com bubble, it looks crazy. If you look here, this was the dot-com bubble. Nasdaq went to 4,800, then we went down all the way to less than 800. During the credit crisis, couldn't rally up that much, only 2,000 to crash back down again to approximately 1,000. But after that, the golden era, shall we say, of the tech stocks kicked in, and then this top right here, I mean, yes, it took you 20 years, but this top right here for the Nasdaq was nothing compared to where we are right now, or which we have topped out 16,000 right now, trading around 10,800. Again, I do think there might be some more downside to go, but also here try to see it in perspective. And another thing is want to add to this is that you have time to buy. If we're zooming into 2008, 2009 credit crisis, you can see that you had weeks and months to buy in. This is kind of a W formation, 112 days, so 3 months was the bottom formation. So if you are interested in buying into the Nasdaq, you do that around these levels, and then you kind of have an average price. But you could also say, yeah, well, Ray, how do you know what the bottom is? Well, like I just said, if you just use common sense, you know, minus 30%, that is already quite a lot historically measured. Yes, we could go further down, but then just make sure to give some money on the sidelines and just buy your way in when we are going down, and then you will get a little bit of an average price, also named the famous DCA strategy, and then just hold it for a long time. If you do stock picking and you bought Tesla and all kinds of other tech stocks, yeah, then it was extremely painful. I think down some stocks 60, 70, 80 to 90%. You have to ask yourself, was it maybe overvalued? Why did I buy it? I never bought Tesla stock because I saw a price to earning of 250, 350 and I thought, I'm not touching it. Well, now it's down a few $100, but I'm still staying very, very careful, but just buy then quality companies. I am doing it through an ETF on the entire index to make sure that I am not exposed to these kinds of dangers of stock picking and then just having one stock going down 80-90%. Gold. I have a bit of a weird relationship with with gold. Yes, full disclaimer, I own gold and silver minor stocks. 2022 was a pretty flat year for gold. You could say, well, you know what, stocks went down, gold almost had a zero return, so you beat stocks. Yes, that's true, but I also had a heavy inflation, and gold in that case was not my hedge against inflation. The almighty top is $2,070. We hit it twice. Question is, can we break it on a third time, or will it be the forever high? Some analysts say that we are going to hit it and going to bounce off again. Other analysts say that we will break it and make a new all-time high for gold. And some analysts say that gold will double. I'm not in that camp. But if it doesn't happen now on the third tap this year, then I think I lost my faith forever with gold. But I also stated multiple times on the channel, how much shit do you want to see? How much more does need to happen for gold rallies up after now we have seen with supply chain, Russia, Ukraine, inflation, central banks, yada yada yada. But still people are running towards the dollar and not really towards gold. So I find that interesting to see. Quickly then on the dollar index, that's another one I quickly want to show you. We have been using this a lot of times for the channel. This is on the weekly. On the daily, we still have that almighty big bullish divergence here on the momentum wave. That actually still looks pretty good. And the price is coming down a little bit. That's completely fine, but I also here do not believe that this was our top formation. I do think that we once go higher, maybe make a lower top a equal high, or even take out this top if, let's say, we have another spike in inflation. But I do not think that this was it. Now we're going lower and it's over. The same is also happened if we're zooming out here on the weekly on a very big top that we put in right here at the 2000 to 2002. And again, mind you, this is on a weekly, so it took years for this top formation, and you can also see it went up, went down, went up again, down, and eventually that was the beautiful kind of a distribution what you had, and then we really went down for the years and decades to come. So I am still keeping an eye on that. I still think we once go higher, no matter what the narrative. Could be inflation, could be Fed, could be stocks, whatever. China, I have no idea, but I am expecting that then there will probably be a little bit more downside for stocks, so just keep that in mind. And then we do see a people fleeing into the dollar index, and maybe then also gold will go down a little bit. So far we had a pretty good year. The narrative for the first 6 months, I think, still will be inflation. Yes, inflation is coming down, but it will be inflation, and later on this year it will probably be something else. If we don't get a big second spike up to, let's say, again 8, 9, 10%, then inflation is completely back on the menu for the rest of the year. But the Fed, of course, has been rising interest rates tremendously to fight inflation. So they will probably do that in the next couple of months as well. I hope inflation will then come down, and then eventually also becomes a little bit less important. But for the Fed, they are still aiming for 2%. Core inflation, of course, that one has a double peak. This one is finally now coming down, also quite drastically. But the unemployment rate still stays very, very low. This needs to go up. This is unhealthy. So the unemployment rate needs to go up. Inflation needs to go down. Therefore, the interest rates need to go up again. This is the last picture that I want to show you. This is from visualcapitalist.com, and it shows you how the Fed is rising the interest rates. And they're doing that on the fastest pace ever measured in history. Reason for that is because if they're doing it on a much slower pace, inflation could A, be much higher, and also B, take a much longer period of time. Inflation in the 70s, and that is very much comparable to the situation where we are in right now, they were not fast enough and were not ferocious enough with the interest rate hike. And therefore they had a double peak, and inflation took almost the entire 70s before it really came down. I think it eventually spiked up to approximately 14%, came down to 2-3%, and out of nowhere, boom, inflation spiked up again. So therefore that is a lesson that the Fed learned from the past. Keep on rising the interest rate. Yes, it will hurt the economy. Yes, people will lose their job. Yes, the stock market and crypto and real estate, everything will go down. They totally understand. But I said already many times before, inflation is total destruction of Western capitalism. If you have not a good price mechanism, then capitalism cannot work, because what is everything worth today, tomorrow, or in a few days from now? And you get total riots eventually in the street. I mean, we have seen it in other countries in the world. So you want to have inflation down, then rather no growth, less growth in the economy, but you want to see inflation low or normal at approximately 2%. And that is the reason why they were quite fast. I do believe that it will keep on rising the interest rates at least for the first 6 months of 2023. It will probably be on a much slower pace, so I do not expect a lot of 0.75% rate hikes, but more 0.5 and eventually maybe 0.25, and then maybe a few months 0, just to see what the effects are, because the effects are lagging 6 to 9 months until they see the real economy, and then they can make a decision if what they did in the past was good or not. Jerome Powell also said it multiple times, the real effects of our actions still need to be felt into the economy, because our economy, the Western capitalism, is just so big, there's so many cogwheels just turning and touching each other. Means that if they rise the interest rates today with 1% or 2%, you will see the effect 6 to 9 months later, and therefore also you will see that the unemployment rate goes maybe up a little bit later, because first the company need to feel the pain in higher interest rate, higher cost of money, more expensive loans before they decide to lay off people. On the other hand, mortgages, they will feel the effect right away, because if the central bank rises the interest rates today, then the regular banks, wherever then you have your mortgage, JP Morgan or all kinds of banks in the US or Europe, they will also then follow with the interest rate hike quite fast, sometimes a couple of days, couple of weeks, and then you also see the effect right away in the mortgages, because someone who gives you the mortgage needs to lend the money from the bank. So that's kind of where it how that is a very short cycle, and other stuff takes much more time. So that you kind of have a feeling why that takes more time, and therefore also you see in the newspaper that some companies saying this year is when we feel the real hits. For us as traders, this is important to know, because the stock market is a mechanism that looks into the future, and therefore it's always kind of running ahead 6 months approximately, meaning that you might still feel all kinds of pain with your mortgage or being unemployed later on in 2023, but the stock market probably already bottomed out much earlier, and therefore I am saying again, first 6 months for the stock market probably going to be rocky, probably a bit more downside. Do not expect another 20, 30, 40% drop, but the second half of 2023 is probably going to be better. For Bitcoin, I expect sideways accumulation phase. Most of the pain is in, and eventually we might rally up a little bit later this year, but do not expect any firework in the next couple of days or weeks. A little bit of a longer video. I hope that you like it. I hope it kind of sets the mood or just widens up your perspective on the markets and where you are and what we can expect. If you like this content, I really would appreciate it if you would like this first video of the year, if you would subscribe, leave me a comment or share the video with your friends or family so that you can share the knowledge. I mean, it's completely free to do so, so I would highly appreciate it. And I'll see you then in the next one, where we are finally going to do our deep dive into Bitcoin. Thank you guys so much. See you in the next one. Bye bye.